Ladies and gentlemen, welcome back to the channel. Stocks are coming under pressure yet again today. The S&P is down about 0.5%. NASDAQ down 0.7%. Russell down 0.1%. We do have some breaking news to go over today. Some headline news, different Fed officials that spoke today. Some economic data, PMIs, Philly Fed data, initial jobless claims. We do have Walmart earnings to discuss in this video, but mainly we really need to talk about tomorrow's catalyst, and that is Fed Jerome Powell. Fed Jerome Powell has the power, if you will, to influence this market dramatically, and I actually think that's why stocks have sold off the last couple of days, just because they're a little nervous on what Powell could say. Personally, I think that's a little overdone at this point, but we'll discuss that here in this video. Hit that like button and subscribe to the channel if you have not done so already. Check out that link down below in the description of this video. If you guys want to come join the trading community, come invest in small cap AI stocks with massive upside potential. I'm not a financial advisor, not a fortune teller, not going to guarantee that you're going to make money. You could lose all your money if you blindly invest or trade based on someone else's opinions. But I do have a lot of confidence in what we are doing. I mean, I bought IONQ at $7. Okay. I bought Nebius at 20. I bought, Novartis Semiconductor at $2. I bought Applied Digital at $3. All of those stocks are up like 500% since then, like crazy returns. Even in the trading portfolio, it's up 56.5%. It was up 94.5% at one point, but the last month has been pretty rough for a lot of your risk on stocks. But still, even 56.5%, a little bit more than that, is better than like 98% of other firms. So like, we are executing, that's for sure. Check it out, link down below in the description of this video. But with that said, on to today's episode. But first, let's get into your headline news today. It says here, U.S. small businesses grew increasingly upbeat in July as conditions improved, despite growing concerns over the jobs market. It says here, the Justice Department plans to investigate Fed Governor Lisa Cook for mortgage fraud, per Bloomberg. Advisor Navarro says he sees a doubling of India tariffs taking place August 27th. Navarro says that India is quote-unquote the laundromat for the Kremlin. And Navarro says it is nonsense that India needs to buy Russian oil. And the DOJ says Fed Cook's criminal referral requires further examination. Now, the Department of Justice, the DOJ official, urges Fed Powell to remove Governor Cook. Navarro says that Powell is so anti-Trump, it's unsettling. Trump trade advisor Navarro on the EU says we maintain tariffs on steel and aluminum. Navarro says on the EU, we will impose 15% tariff on autos, a drop from 25%. And Navarro says that no other deal is more important than with the European Union. Fed Hammock says, I don't think the Fed policy is far from neutral policy. There is no need for stimulative policy. So, little bit of bad news per se from Fed Hammock today. Fed Hammock, though, says, I do not see any sign of a notable economic downturn, which is good, right? That's bullish, because you don't want the Fed cutting rates because of an economic downturn. That is never going to lead to stocks going up on those kind of rate cuts. Fed Hammock says he does not see an imminent case for cutting rates based on the current data. And if we look at the Fed rate monitor tool and what's now being priced in for September, we can see there's a 69.3% chance of a cut September 17th and a 30.7% chance of a continued pause. So we are, still pricing in a cut, but the odds are falling basically every day, okay? Based on what Powell says tomorrow, you're going to see a big move in the expected path forward for rates. Now, we have to understand the Fed is basically compromised at this point. Again, Hammock says here, with data now, wouldn't see the case for a September cut. like we didn't just only have 14 jobs added in May and 19,000 added in June. Like, that's not getting, too close for comfort with policy this far above inflation, presumably, 2% higher than where it should be. Like, the Fed is pretty well compromised at this point. I'm hopeful that Powell is not a super, hawk tomorrow. I think if anything, we're going to get a neutral Powell. And a neutral Powell is a Powell that's priced in by the markets. Like, a neutral Powell that doesn't say it's impossible to cut rates in September, doesn't guarantee a rate cut in September. Basically the same Powell that we've had is like a neutral Powell, okay? If we get that, it's priced in, that could actually be an upside catalyst for stocks at this point, right? Because it wouldn't be any new bad information. Whereas Wall Street in the last couple of days has grown nervous about the Jackson Hole speech. So I think you're actually set up in a positive way heading into tomorrow. Like, the last thing you would have wanted was stocks that go straight up and then a big disappointment from Powell. Like, we've had, 2-3 down days. We're probably set up in a bullish way heading into Powell. Hopefully that is easy for everyone to see at this point. And I think the overwhelming odds are that you don't get a dovish or a hawkish Powell. It's, again, like a neutral Powell, which is just fine. Like, markets can handle that, and that would probably be an upside catalyst at this point. Like, maybe it wasn't as bad as feared if he's neutral, right? But it does seem like the Fed is certainly waiting for the economy to weaken and look more recessionary before some Fed officials want to cut rates. Some of them just, let's be honest, have not a clue what they're doing. Like, if you are team no cut September, you don't have an idea of what you're doing. Let's just be honest there. With the jobs numbers that we just got, presumably going to get even worse, and you don't want to cut rates, you're begging for trouble at that point. Hammock says, I think we have a small distance to go to get to neutral. Fed Hammock says the unemployment rate is one of the best indicators we have. Fed Hammock says we're missing on inflation. We need to stay laser focused. Hammock says labor supply has come down dramatically. Fed Hammock says the labor market could still be in balance despite slowing. Hammock says the biggest concern is that inflation is too high and inflation has been trending in the wrong direction. Putin demands to Ukraine give up Donbass, no NATO, and no Western troops, sources say. Hammock says it's just now that we're starting to see tariff impacts, and we're really not. The latest inflation reports were hot because of services, and Scott Bessent pointed this out. A lot of it was service-based investment, okay, that drove especially PPI up. It was outright services and housing services mainly that drove CPI up. It wasn't the goods inflation, and that's why the Russell went up 5% in 2 days based on the CPI report. It was because it was better than expected, not being affected by tariffs. So I think that's the wrong take. Hammock says we're not going to see the full tariff effect until next year, which is actually funny because Target just said that they've seen the bulk of the tariff pressures and that has passed them. Walmart basically said something similar today, that they're still feeling tariff pressure, but it's starting to come to an end. So, yeah, I don't know where he's getting that from. Fed Hammock says the economic theory on one-time tariff impact may not hold. Again, these guys are incompetent or compromised or paid off or something, because literally it doesn't take a genius to understand this, okay? Like, I'm sure most of you guys understand this. Tariffs do not cause inflation. Why? Basic principles of economics. Taxes do not cause inflation. Unless there is a series of stair-step tax increases, and then at that point, you'd get to 100%, and it would, like, the whole economy would just implode, okay? Tariffs are taxes. Tariffs do not print money. Inflation is caused by excess money. The argument with tariffs not being a one-time impact is if the labor market is so strong that people go to their employers and demand pay increases. And then from that point, theoretically, you get a wage price spiral that started from a one-time tariff impact. So you could have a one-time tariff impact, theoretically, and then have a wage price spiral that starts from there, where you get tariff increases, costs go up one time, people go to their employers, get pay raises, those employers say, oh wait, now we have to raise prices again. And then consumers have higher prices, so they go back to their bosses and they say, hey, we need another raise. And then companies say, oh crap, now we need to raise prices again. That is a wage price spiral. That is not what is happening. If we can't tell, the labor market is not like on fire right now. Okay? So, yeah. I don't know where they get this shit from, but I think they need to like go back to school. Just to be like brutally honest here. Fed Schmidt today says the risk on inflation is higher relative to the job situation. Citi strategist Scott Schonert lifted the year-end S&P 500 target to 6,600 from 6,300. Now here today, we actually did get some pretty positive economic data, not from initial jobless claims. Initial jobless claims came in at 235,000, coming in higher than the expected 225,000, so that was not exactly great. Philadelphia Fed Manufacturing Index as well came in pretty low at negative 0.3. The consensus was 7. Philly Fed business conditions came in at 25.0. The estimate was 21.5. CapEx index came in at 28.40, a lot higher than the previous month at 17.10. Employment came in at 5.9, worse than last month's 10.3. New orders came in at negative 1.9, way worse than last month's 18.4. Prices paid came in at 66.80. Higher than last month's 58.80. So some mixed data there out of the Philly Fed region. But S&P Global Composite PMI came in at 55.4. The estimate was 55.1. Manufacturing PMI flash came in at 53.3. The estimate was 49.8. So that came in better than expected alongside the Global Composite PMI. And services PMI came in at 55.4, beating estimates of 54.2. So better than expected data there from the PMI today. Existing home sales came in at 4.01 million. The estimate was 3.92 million. And existing home sales month over month came in up 2%, better than the forecasted negative 0.2%. The CB leading index came in at negative 0.1%, better than the negative 0.2% forecast. Okay, now again, tomorrow you're going to have Fed Jerome Powell's speech at 10 o'clock in the morning, and that is the big catalyst for markets. I mean, really this week, which is funny because ever since 2022, Jackson Hole has not been a catalyst, but people have been so nervous about this one for one reason or another. I think we're going to get the same Powell that we've got previously. Now, if we get the same Powell that we've gotten previously, he's not like more hawkish than the last Fed conference. That to me seems like a positive catalyst for stocks. And it seems like stocks would recover on that. Do we need rate cuts to fuel this market? No. We need rate cuts for the right reason. So if Powell is hawkish tomorrow, that means Powell thinks the economy is doing just fine and that there's no recession risk, which is actually instinctively positive. Okay, so we'll see what happens tomorrow with Powell, but I'm not concerned heading into it. Since the last 2 or 3 days, we've seen selling pressure on markets. And really, unlike the Russell, ever since August 13th, we've seen selling pressure on the Russell. Like small caps are down like 3% from highs. in that period. I believe the S&P is somewhere around that as well. The S&P, since its all-time high, is down about 2% from highs. And I believe the triple Qs, the NASDAQ, is worse off. The NASDAQ from all-time highs down almost 4%, about 3.5%. So I think we're, looking good heading into that Fed meeting. Now, we do have a trend line here. I actually haven't looked at the triple Qs and the chart specifically in a while. If we break this trend line to the downside, it could get ugly if markets do not like what Powell says coming tomorrow. That is a risk, obviously, that needs to be factored in, and you need to be ready for the markets to throw up on Powell tomorrow. I just don't think that's the most likely path forward, given we've already had this weakness heading into it, and sentiment is very low. Like, nobody's expecting anything good from Powell. Now, we also had Walmart earnings today, and this is really all that matters in terms of the economy. And I think this is likely why the odds of Fed cuts in September are falling. Now, Rainey, a executive at Walmart, says Walmart hasn't seen a change in consumer spending. For an example, sales of private label items, which typically cost less than traditional brands, were roughly flat year over year, he said. He said, quote, everyone is looking to see if there are any creaks in the armor or anything that's happening with the consumer, but it's been very consistent, he said. They continue to be very resilient. Okay. Yet on the company's earnings call, CEO Doug McMillon said middle and lower income households have been more sensitive to tariff-related price increases, particularly in discretionary categories. Quote, we see a corresponding moderation in units at the item level as customers switch to other items or in some cases, categories, he said. So Walmart actually raised guidance yet again today. Consumers doing okay. Are they doing great? No. But are they holding in there? Is it business as usual? Pretty much. And that is what I would call good news at this point with the growth scare that is currently, taking place in markets. TLT today is actually yields are coming down. The last 2 days, yields have been rising, so that's a little interesting. Looks like a little bit more kind of what we've been used to, right? Bonds down, stocks should be up today. Is that what I'm getting out of that? Usually there's a opposite correlation. So normally if bonds are down, stocks should be up. If bonds are up, stocks should be down, which is what we've seen over the last 2 days. So today is a little bit different. And even then, like, the RSI is back to neutral on the S&P. It's at 52.86. On the triple Qs, the RSI is at 46.5, so it's even below neutral. On the Russell, it's probably below neutral as well. Just give me a sec here to pull that up. No, it's at 54.42, so pretty neutral there as well. Like, you're not super bullish heading into the Fed tomorrow. Let's see if we have a new AI investor sentiment survey that comes up. Wow, that's surprising. Bullish investors went up to 30.8%. Neutral investors at 24.4%. And bearish investors at 44.8%. Honestly, that is not what I expected to see, but still to point out here, bearish investors at 44.8% and bullish investors at 30.8%. Normally, bullish investors are going to be higher than bearish investors, typically. Like, the historical average is 37.5% bulls, 31.5% neutral, and 31% bears. Normally, there's even more neutral investors than bears. Right now, bears are almost 2-to-1 versus neutral. Like, people are very bearish right now. And we're very bearish heading into a catalyst, which is likely going to be neutral with Powell tomorrow. That likely sends stocks higher. Now, is that a guarantee? No. But the highest probability is of upside tomorrow, in my opinion. Now, the CNN Fear and Greed Index today coming in, let's give this a refresher. Coming in at 55 today, which is neutral. Market momentum is neutral. Stock price strength is greed. Stock price breadth is neutral. Put and call options greed. Market volatility is neutral. Safe haven demand is fear. And junk bond demand currently in greed. The percent of stocks trading above their 50-day moving average coming in today at 55.12. So about, right in the middle, about as normal as could possibly be. Kind of starting to slip lower though, meaning that only about half of stocks are trading above their 50-day moving average. That's a very short-term moving average. This market is definitely reset more under the surface than what you'd even see if you looked at, again, the headline S&P, headline NASDAQ, or even the headline Russell. Stocks for the last month now have generally been trading lower. And over the past week here, you can see flows into the US are net positive. So you have inflows of 39.68 billion, outflows of 33.51 billion. So you have a net flow of 6.17 billion into US markets or into US ETF markets. That is a positive sign. So let me know your thoughts on all of this down below in the comment section. I just again want to say I don't think this is the start of a recession, so I don't think this is the start of a bear market. I don't even think this is really the start of a larger growth scare, because growth scares cause corrections like 10%, 7% corrections. Recessions cause bear markets. I don't even think we're going to get a large growth scare here. I think people are all nervous about what Powell's going to say, and then he's not going to say much of anything. That's what it's looking like to me. And that turns into a very positive catalyst coming tomorrow. So let me know your thoughts on all of this down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. Check out that link down below in the description of this video for the trading community. Have a great rest of your day, and I will see you in the next one.